This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. On today's episode, we were joined by Randy Cass, who founded and currently runs Nest Wealth, which was, at the time, and I wrote a blog post about this when it came out years ago, they were the first Robo-Advisor or online portfolio management firm, whatever you want to call it, in Canada. So Randy was way ahead of the curve.
Way ahead. And he's got quite the background too.
Yeah, I think he sold one company, but he's always been an entrepreneur. He's been on TV, BNN for a long time.
You got to hand it to him. He took a lot of courage to launch that kind of firm. It was a big risk. And he even talks about how with Vanguard coming out with, arguably some competition with one decision type funds, how we view that competition and how he's using technology to deliver better customer service and starting to use some of the data they're capturing, which will be really interesting to see how that evolves over time.
Yeah, and using technology to scale advice. He had some really good ideas around that, which is directly applicable to us. I think Randy even made the joke, when are we announcing our merger or something like that?
Yeah. And also their fee model is super unique too, which I don't quite get how they make ends meet, but they seem to.
Flat fee. Well, when you start thinking about that though, you compare Nest Wealth fee, I think their highest fee is $80 per month. You start comparing that to the average account size at Wealthsimple at 50 basis points.
Right, but if they can deliver to much larger money, it's not a lot. Anyway, so he was high energy. He was totally engaged, super interesting.
I could have kept that conversation going for a while. I thought it was really interesting.
Cool, there you go.
So, Randy, thanks a lot for coming on the podcast.
It's my pleasure.
You launched the first online portfolio manager or robo-advisor, as they're often called, in Canada, well before a lot of the other players came. How did you know that there was an opportunity there?
In hindsight, it seems so obvious. At the time, I don't think we knew that there was an opportunity in Canada. I think it was the significant kind of entrepreneurial moment where I was hosting a show on BNN called Market Sense, and I had already sold my first startup called First Coverage, and I was trying to figure out what I wanted to do next. And I kept having these CFOs from the large banks and the CEO of mutual fund companies and regulatory body heads come on. And the thing that kept amazing me was no matter how good the quarterly profits were for the banks or how much further the regulatory bodies wanted to pursue their investor advocacy mandates or where we were going with fund company economies of scales, it just wasn't getting better for the end investor. The fees weren't coming down. The product selection wasn't gravitating to what would really be in the best interest, I thought, of an investor at the time. And eventually you just have that moment where you're like, look, I can keep pestering these significant executives as they come and sit here and be interviewed, and I can ask them when they're going to do something about it, and I can kind of push the regulators to move faster. But at some point, I just decided that there was an opportunity for a better solution that would exist in Canada. I wasn't certain it was going to be what we now look back on as a robo-advisor. In fact, when we launched Nest Wealth, it might have looked digital on the outside looking in, but it was an incredibly manual process behind the sign-up screens and the rest of it. I just knew that the combination of lower fees, greater convenience, greater transparency would find a market. I mean, anytime you put a better product in front of people, you hope that it will find a market. But to say that we knew there was an opportunity for a digital advisor in Canada, I think is just being said with 2020 hindsight right now.
Can we back up for 1 second? And I just want you to elaborate on the manual processes and what those look like now, because it sounds like based on what you said, that has changed.
Oh, it's totally changed. I mean, back then, everything from submitting a form to the custodian to actually making sure that you were getting the IDs where you needed to get them, to making sure that the money was coming in. It might have looked like it was seamless to the investor. And at those times, it's really important. And this is not just something that exists within Fintech or the financial services field, but it's any time that you're an entrepreneur and you're building something that's going to disrupt. you always start off by doing things that won't necessarily scale in any significant way. That's how you determine that a market exists. And so all those things that we wanted to do, it would be foolhardy to spend tens, hundreds of thousands, millions of dollars to build the foundational products for them to actually make sure that on the back end, everything was as digital as it seemed on the front end. But today, I mean, where I was just talking about this with someone yesterday, actually, we're coming into our fifth RSP season. I mean, your digital advisor, your robo-advisor is growing up. It's what's between a toddler and a tween, right? It's 5 years old now. And all the stuff that 5 years ago seemed like miracles is now actually just table stakes. And we've come a long way. And now when someone fills in a form online and uploads their information, and it gets fed right into the book of records, right into the back end of the custodial system. When money comes in, when transfers are initiated, it's all done like you would hope it would be a seamless experience. But back then, I don't think the question leads to the right answer. I don't think we knew back then that there was an opportunity. I think we thought there was a need for a better solution for Canadian investors. I mean, but to say we knew that it was going to be a digital solution probably gives us some foresight that we maybe didn't have.
So interesting. So speaking of disruption, Randy, you have a very unique fee model. So you talk about your decision to charge a low flat fee as opposed to a more traditional, assets under management type fee.
Yeah, I mean, this was, for me, the moment where I thought we had something that was going to distinguish ourselves in the marketplace. And for those that don't know, Nest Wealth clients, every single one of them pays a flat monthly fee of either $20, $40, or $80 a month. And it's regardless of how big their account sizes grow. So, I mean, compare that to a standard mutual fund, and someone with hundreds of thousands of dollars all of a sudden is keeping hundreds of thousands of dollars over their investment horizon in their pocket as opposed to being paid in fees. Look, I had a belief that if we were really going to take a stab at making things better for the end investor, everything had to be on the table. And the notion that we were going to build a technology first company, that we would have no legacy solutions that we have to work around, that we would build a product that we said was the best possible one for the investor, and then stick to an old pricing model where the more you gave me, the more I charged you, even though it was for the same level of services and the same set of activities we were going to do. It really didn't have a leg to stand on. I couldn't justify taking in someone with $1 million and charging them 5 times as much as someone with $200,000. So the very first thing we did was say, look, our services more or less as a digital advisor are going to stay the same. We can build, manage, and run your portfolio as efficiently at $1 million as we can at $150,000. So why would we charge you 5, 6, 7 times as much? And that was, for me, the real thing that was going to disrupt the marketplace. I mean, when you think about it, digital does 2 things really well. It does distribution really well, which means that if you're online anywhere in Canada, all of a sudden you have a host of selections to invest in that you never would have had unless you were living close to a financial advisor. And the second thing it does really well is if you build smart and you don't build into the model boardrooms and big offices and impressive sales forces and the rest of it, you can really begin to take the cost down dramatically. And so digital was clearly going to level up the access to sophisticated financial services. And then it was our mandate to say, let's be really fair about this and only charge people the value of the services that they're consuming. And that won't change with the amount of assets that they're giving us.
Makes a lot of sense. Now, the big question that comes up in my mind when you start talking about that is just from a business model perspective. I get that there are places where costs can be reduced, like not having big fancy boardrooms and things like that. But something that doesn't go away, and this is something that we see on the ground every day, is questions from clients, which you need people to answer. Now, your business model would require a larger number of clients than ours does. So my question is, how do you handle all the questions from clients?
That's a great question. And it's there are a couple kind of holy grails that you need to wrap your hands around to make a digital model like Nest Wealth really, really work and really fly. And that's one of them. And so I think there are two ways that we do that. One, we do what we think is a fairly exceptional job of preparing people before they become Nest Wealth clients as to what they can expect. Not just what they can expect from the portfolio managers that they deal with or the customer experience team that they have access to, the channels that they can access them through, chat, phone calls, email, whatever it is, but also what they can expect when we put them into their financial portfolio, from a level of volatility that might be normal to what kind of risks they're comfortable taking on. And that does a couple things. One, setting up their expectations as to what they can expect well really allows them to be comfortable with a lot of the things that are going to happen. So when drawdowns happen, when market volatility happens, they have visual representations on their technology platform when they log into their account that remind them that this is within the range of tolerance that you said you were comfortable with. And if you can do that well, and you can have that conversation before they open the account, then it's unlikely they're going to call you just because there's some volatility in the marketplace. And our calls do not go up when there are drawdowns or volatility in the marketplace. The other thing we can do with technology is we can actually look at the people that are exhibiting different behaviors than they otherwise would, logging in more often, adjusting variables in their portfolio settings or their goals. And we can proactively reach out to that group of people with some messaging that helps them recognize there are people watching over what's going on right now, but at the same time, doesn't bother 95% of our clients who are just going on living their lives like we asked them to, with an email that says, hey, don't worry about things. Things are fine. And now they're wondering what they were supposed to worry about. So in that sense, we actually do quite a good job of minimizing the number of reasons that people have to call us or at least get concerned and call us. And then the other thing is, when you think about, Ben, the type of portfolios that we put together, they're low cost, they're passive, they're ETFs. No one's going to reach out to us and ask us, why'd you sell Apple? Or why are we holding Tesla? Or any of those other questions that make up a large amount of conversations that would typically be had in this industry. So we have taken a set of conversations that would be enormous, and by hopefully setting expectations properly and limiting the conversations that people would have reasonable expectations of wanting to have with us, taking it down to a level that allows us to scale to a level that traditional firms would really have trouble with, I think.
So Randy, where does Nest Wealth fit into the landscape in terms of there's things shifting in the marketplace where Wealthsimple is offering, I believe, some sort of increased amount of advice? And then at the other end, you have Vanguard and iShares offering, super cheap, pre-built, one decision asset allocation type ETFs. Where do you see Nest Wealth fitting in the marketplace between them?
Well, I mean, there are two areas that we kind of differentiate ourselves on. One in the consumer side of the business, and then the other is a large portion of what we do here at Nest Wealth is provide the technology and the platforms for financial institutions that are looking to bring digital into their wealth management practices. And we can speak to that in a bit, but in that area, we're not only the Canadian leader, I would go so far as to say we're the global leader in the number of digital rollouts that we've done to support financial institutions like National Bank. We have MD, which is now part of Scotiabank, using our white label solution, Aligned, a whole bunch of other ones across Canada. And I think we've really distinguished ourselves in our ability to allow financial institutions to digitize what they're doing in a way that's better for them and their clients. On the consumer side, I think we differentiate ourselves in a few ways. One, we kind of one day we sat down and we said there were 5 Ps, and I'll have to kind of make sure I remember all of them here. But one obviously is pricing. We honestly do our best to make sure that our clients end up with as much of their potential wealth as they can. And the only way you can do that is with a flat monthly fee. If you're going on a percentage of assets under management, they're never going to get to the level where they keep 100% of every dollar that they continue to put in. So pricing is a distinguishing feature. The other is product. We really do focus on using the cheapest and the best and the most liquid products in the portfolio. So not only do we have the cheapest fees in the country for our investors, but we have the cheapest products in the portfolio from a cost point of view. So combined, we might be half the cost of some other ETF portfolios that are out there just on the management expense ratios of the products. Protection, we don't custody our assets ourselves. We custody them at places like NBIN, which is National Bank's custodial arm. We custody our clients' assets at Fidelity Clearing. We make sure that there is a large iron curtain that exists between or a Chinese wall that exists between where the assets are held and the people managing your assets. And our clients really appreciate that. The professionals here, the portfolio managers that are engaged with our clients' portfolios, have been doing this for decades. I've been doing this for decades. We're the only digital firm that exists in Canada where every client still gets a conversation with a portfolio manager. We're the only ones that take the time to reach out and make sure that the profile that they filled in digitally is the one that allows them to have the best chance at reaching their goals. There's a level of professionalism that we bring that we think is reflected in the demographics of our average client is about 47 years old. The average assets they hold with us at Nest Wealth are about $175,000, which is dramatically different than, for example, a Wealthsimple that I think is about a $15,000 average balance. I could be off by a few thousand one way or the other of that. And then the final thing is personalization. We built our technology so that every single client that goes through gets a portfolio that's constructed in a way that's personalized to them. We don't have 5 or 10 buckets that we drop people into based on how they answer the profile. We make sure that what we construct for them sits on, this is getting a little geeky, but sits on the efficient frontier, which means that for every dollar of risk they're taking, they're maximizing their return expectations. And we create a portfolio that resides there for each and every client. I really think that when you look at the Vanguard products, they're phenomenal. And for people that want to take carriage and do it themselves and watch it and make sure that they're doing something without any guidance because they can handle it, I think that's great. For those that might have a lower asset base, 10, 15,000, and are looking to kind of be part of the Wealthsimple community, I think they've done a great job building their brand as well. Where we really find ourselves is those that have gathered some assets so far in their life. They're getting serious about trying to figure out what they're going to do or how they're going to stretch the assets to satisfy their retirement or as they enter their earning years to really grow it in a way that's safe and maximizes the wealth they'll end up with. And they want a bit of guidance. They want someone they can reach out to when things get dicey if they want to. They want someone that's constructing the portfolio and watching it. And more importantly, they want the peace of mind that it's being handled by someone else. And they put a buffer between them and the ruiniest things that humans tend to do in moments of volatility, which is sell at the worst point, buy at the worst point. We're the wall that allows them not to do that and to focus on the rest of their life. And for 20, 40, or 80 bucks a month, our clients tend to value their time in a way that that's one of the best deals they have going right now.
Yeah, the wall is something that we hear from our clients as well as being one of the nice things about having somebody else thinking about this for you. Now, Randy, you just talked about a lot of stuff that a lot of it sounds like traditional wealth management, where you actually have a portfolio manager to talk to and you're actually getting financial advice. And that's one of the things I want to ask you about. Our firm focuses on having a very low ratio of clients to advisors and a lot of hands-on relationship and stuff like that. Obviously, just based on your business model, your firm has to be different, but people still want all the stuff that you just described. So how do you, I get cutting off a lot of the questions up front, but when we're talking about financial advice and those types of conversations, how do you handle that? And can you use technology to scale advice?
It's a great question. I think it's where this industry is going next. Look, I think I'm a huge admirer of your firm and what you do and how you do it and the foundational practices you guys have always had. And I think you'll agree that this industry is changing dramatically. In 10 years, you're not going to recognize it from 10 years ago. And over those 20 years, the bread and butter of what this industry used to sell, which is we're going to figure out what the portfolio should look like, and then we're going to watch it, and then we're going to pick the stocks, and then we're going to do all these things. That's commoditized in many ways. It's just not going to carry water for saying that now you're going to pay us a ridiculous amount of money because look at all the great things we did. If you want that, you can come to Nest Wealth. You can go in the States to a Betterment or a Wealthfront. There are all sorts of solutions for individuals to have that done for them, which leaves the obvious question, what do you do if you're an advisor in this industry and you've built a business that necessitates you get paid 100 basis points or some amount like that? And the only possible answer is you need to figure out how you can add significant value in areas outside these traditional things that we just talked about. And here's where I think the combination of what we do and what firms like yours do going forward. Let's go back to that example I mentioned where there was a nervous investor and technology allowed you to identify who it was and reach out to them in a way that was different from others that were just carrying on with their lives. If you scale that in a book, just imagine that you're an advisor and you either have a platform that allows you to do that or you don't. If you scale that to the size of your book, the advisor who's using technology to figure out where to allocate their resources, who to call, what to do, is going to be vastly better served than the one who's guessing which clients today are being affected in a way that I might need to reach out to them. And then when you think about things that the advisors can do going forward that can be supported by technology, take the next great black hole of this industry, which is deaccumulation, right? It's a massive problem for people. We've spent 50 years building an industry on how to save money, and now no one knows what to do when it comes to telling people how to spend it. That is a computational horsepower question that if you have the right technology and you're an advisor and you can manage that technology and slide a piece of paper across the table to tell your client, look, if you follow these steps and let me take your assets here and do this for you, we can extend your wealth by 120,000. We can adjust it to the lifestyle you want to lead in retirement. To me, the future of this industry is a combination of technology and the advisor. That being said, I think everything we've talked about scales in a way that technology handles it very, very nicely, but the advisor of the future is going to carve out their practice by using other technology to provide value in more sophisticated areas. So I have no issue with the notion that our platform, our business model can scale to tens of thousands, hundreds of thousands of users without having to see a linear scale in the employee base we have. But where I think the value-added services for you guys will be is by using technology to demonstrate how much more you can add to your clients than you've ever added before. Does that answer the question at all?
Totally agree with everything that you said. I see the future of the industry going in the same direction as what you just described.
That's great. All right. So are we announcing the merger today?
Have to work on the press release, I guess.
Those are a dime a dozen. We'll get that out.
So let's talk about the portfolios, Randy. So you're managing the money basically in low-cost market cap weight type tools. Do you foresee that changing over time? More and more awareness around factors and tilts and whatnot?
Yeah, it's interesting. We did a survey of our client base a few months ago, actually, and we asked them a couple things about this. We asked, look, because our client base, I'm talking the direct-to-consumer client base right now, and then we'll talk about the advisor client base as well in a second. We asked our direct-to-consumer client base, look, are we missing the boat here? Like, are you interested in investing in themes or factors or socially responsible investments and anything but this low-cost kind of mantra, the plain vanilla passive portfolio that we've put together, which objectively is the best way to accumulate wealth, but emotionally might not be satisfying the requirements of some people out there. And about a third of our clients said, yeah, you know what, we are interested in doing something outside of passive plain vanilla. And so on the plus side, I'm kind of internally happy that 2/3 recognize that investing is a means to an end. And you shouldn't, unless you're looking for it to back up your lifestyle and represent your social views and you have issues with doing things that conflict, which I totally get, using it as an entertainment mechanism or to back up your pet theories is not something that we enthusiastically support here at Nest Wealth. But that being said, getting people to save, getting people to invest, getting people to plan for their future is better than not having them plan for their future. And if we can start adding things that encourage people to begin to save a little more, and even if it becomes satellite portions of their portfolio, I'm all for that. So I don't think we'll be 100% passive all the time. I do think it's the mantra that we're most comfortable with from a business to consumer point of view here. But look, our B2B partners, digital to them is a distribution channel. It's a better user experience. It's a better user interface. It's obviously a better economic experience for the industry as well. And they are putting all sorts of products and portfolios in the back end. And so, look, if you think of it as a distribution channel, we'll continue to evaluate the options. But as of today, you're right. We have stuck plain vanilla passive, boring, but incredibly effective.
So you just touched on a little bit of feedback that you got from your clients, and that's another one of the things that I wanted to ask you, if you're willing to answer it on the podcast. But what I want to ask is, what's the most common complaint or constructive feedback that you hear from your retail clients, your direct to consumer clients?
And I'll answer it honestly, and it's where the new kind of intersects with the older legacy systems that we still continue to have some issues in Canada. And I can give you 2 examples. We have multiple custodians on our back end. Some allow us, as I mentioned at the start, to go digitally right through to the book of records. Others still have, believe it or not, solutions in place where they might take the data that comes in from our system, print it off, key it into another data system, and then put that into the book of records. In some cases, it can take more than a day, 2 days, 3 days to have that occurrence happen. And you can imagine a client who's interested in a fully digital experience might not anticipate that type of delay. And our custodians are getting better, much better at that. But that's one area where setting expectations for clients who expect instantaneous satisfaction and everything might have been outside the realm of what I don't get, why I have to wait 24 hours or 48 hours to open this account. So they're getting better there. One of the areas that I don't think we're getting better at in Canada and is clearly probably the greatest level of complaints that we get as a company is the transfer process, where they're moving an account to Nest Wealth. It's coming from a large financial institution. And for one reason or another, in the best case scenario, that might take 8 days, 2 weeks, let's call it. In a worst case scenario, you'll all of a sudden get all sorts of roadblocks and hesitations being thrown up by financial firms that say, oh, we don't take digital signatures for transfer outs, even though it's been legal in Canada to take digital signatures for transfer outs for a decade. They might say, oh, this came in as John instead of Jonathan, so can you please redo it and confirm that this is the right person? And that level of placing obstacles in what's clearly something that a client wants to do leads to a genuine sense of frustration for the client. And we can manage it and we can explain to them, look, we're doing everything we can here. And they'll get very, very frustrated at the place they've asked to surrender their asset base. But it is not a good client experience. And I often say, I sat on the OSC Fintech Advisory Committee for a couple of years. And when I started, I actually thought that the biggest obstacle facing Canadian startups might be the level of regulatory requirements that we need to abide by. I don't actually think that anymore. I think the greatest obstacle to startups in Canada in the fintech space is allowing the larger institutions to be obstructionist in what they are able to say and do. So, for example, the law right now is that digital signatures are legal. That's great. It really should be that digital signatures can't be refused, because until you close that gray area, that's one example of firms being able to say, oh, we're not going to do this, and us and regulators being stuck. And if you want to stymie innovation in Canada, if you want to see fintech kind of slow to a crawl, then you can't ignore the fact, or you continue to ignore the fact that large financial institutions are able to be obstructionist in what they're doing to allow transitions of data or financial assets to smaller fintechs.
Yep. We see the same stuff on our end.
So you're building a very disruptive technology firm effectively in the financial services business. I'm really curious, as a leader of this business, how do you frame like business targets? How do you decide what will be a successful plateau at some point in the future? Because this is all so new and so disruptive. How do you do that?
You do it in an iterative fashion. You have to make your bets, for lack of a better word, and you have to double down in areas where you see massive opportunities. So, for example, 3 years ago or 4 years ago when we launched as a direct-to-consumer digital advice or Robo-Advisor, It was a year later when we saw what the industry was doing, and we took a step back and said, look, we think because of margin compression, the real opportunity is not going to be to try and build what we thought would be a very expensive brand in the consumer space, but to build a platform that could allow other firms to enter this digital arena in a cost-effective, efficient manner and be their partners in that sense. And that was a big bet that we made, that the industry was going to evolve that way. And we were right there. There have been other areas that we've doubled down on recently, which is we think the first 2 to 3 years of this industry was really about taking inefficiencies out of procedures that have existed for decades in wealth management and are still paper heavy, and reducing costs so that firms can survive in a lower margin environment. And we've seen that, but now we're betting that the future is going to be about this technology being used in addition to what the firms do today to help them make better decisions, to provide AI to the advisors, to allow them to optimize things like the deaccumulation process we talked about. So you constantly are iterating, and you're constantly looking around and seeing what's happened, what's changed. We think this entire industry is going to be using new foundational products, both on the consumer side and the industry side, 5 years from now, from where they were 5 years ago. And when you think about it like that, we are just at the tip of what this evolution of the industry looks like. And our goal is to make sure that we are one of the major players globally in what is used by institutions to satisfy their investors and best practices.
Last question that we have for you, Randy, and it's gonna turn it inward. It's about you. You've obviously been an entrepreneur. You've had you've sold one company, correct?
Yep.
Yeah, so you've sold one company. Now you're building this second company, which is super cool, and you've got some big goals, which is awesome. How do you personally measure success in your own life?
Well, let's end with a simple one, right? I don't do it with dollars and cents. And I think, look, I'm in my mid to late 40s right now. I've got 3 beautiful boys at home. I've been married for 20 years. Those are the things that I gauge success by. And as cliche as it is, yeah, I want to build a huge business. Yes, I want to make sure that what we're doing is something that monetarily bears itself out like I think it can. But we had the opportunity to exit this business for life-changing money a year and a half ago. And to a person, the senior management team said absolutely not. And one of the reasons was we're having a ton of fun here. Like, this group of people is phenomenal. They are driven, motivated, passionate. This entire senior management team has been together from day one with no attrition or turnover. So I measure success in a couple ways. I measure, am I excited to get out of bed in the morning? That's a big check mark. I measure, do I have people I love and that love me around me on a daily basis? And I do. Am I trying to do something good that I feel proud about? And clearly the mission to change this industry for the better for the investor is, and all the participants, is something we're constantly motivated to do. Will I be proud of how I spent my time? Am I spending it effectively? Will I motivate the people around me to be their best? Will we have people from Nest Wealth that go on to start businesses that change the country down the road? Those are all things that become important as you begin to think about these things in a more macro light. So, yeah, look, I get it. I really want to be successful with this one to a degree that money is there, but I want to do it in a way that the ride is as fun as the outcome and the people around me get as much out of it as I do.
It's a great answer to the question.
Yeah, it's a very inspiring response, Randy. And this has been a real pleasure to get to know you a bit better and introduce you to our listeners. We want to thank you very much for joining us.
Thank you, guys. It's my pleasure. And as I mentioned, big fan of what you guys have done over there for a few years now. And I'm glad that Ben and I finally had the chance to sit down on a podcast and talk.